Good morning, good afternoon, everyone. Welcome to our session today. Thank you for joining Counselor Buchanan and Mitchell and MBI. Today's presentation is a market update, financial considerations in today's market. And this is part of our ongoing series. We've been staging these sessions, one every other month. A little bit later in the presentation, Debbie and Alex will show you some of our upcoming events, and we'll be holding another market update at least in November. Debbie May and Alex Seleznev are our presenters today. Debbie is an Executive Vice President with CBM and the Chief Investment Officer for MBI. And Alex Seleznev is our Senior Advisor and Portfolio Strategist. If you are on the call today, we would ask, out of respect and for courtesy for the presenters, to please keep your video and your audio turned off. Please do keep yourself muted. There is a chat box available to you to ask any questions, which is being actively monitored by Alex and Debbie. For those of you who, when you registered, did submit questions beforehand, those have been sent to the presenters, and they will be building responses in during the course of the presentation. But again, the chat box is available to you at any time, so please feel free to reach out. This meeting is being recorded. And finally, the presentation slides will be available after the session later today. So welcome, and I will turn this over now to Debbie and Alex.
Hi, everybody. Thank you, Joe. So I want to thank everybody for attending today, and I do hope that everybody is well and your families. It occurred to me this morning that it is actually 6 months to the day that we sent everybody home from our office. So it's been 6 months and, basically stay at home, work remote. And here we are 6 months later. This presentation is going to be primarily a market update. This is our third presentation since COVID. So we're going to really be focusing on, now we're in the fall, we're pre-election, and we will also have some financial planning ideas that we think are relevant for right now. And as Joe mentioned, our fourth presentation will be in November. It's November 17th, which you'll see post-election. So we'll be able to talk about what's actually happened in the election, as well as year-end planning. He mentioned too that we do have the chat box. So do feel free to put your questions in as they come up. We're going to try to answer them as much as we can in real time. Whatever we can't get to that way, we will definitely save time at the end to do that. Remember that we can't actually answer specific investment advice for you personally. We can't do that in this format. Next slide. Oh, here we are. We are on the next slide.
Yes,
Sorry.
we're on the next slide.
Yes. So MBI basically is a subsidiary of CBM. We're a fee-only assets under management firm. We're currently managing over $225 million, and we do provide comprehensive financial planning services in a number of areas that you can see as part of that process. We also do provide financial planning services and investment advisory services by the hour under the CBM umbrella, which can be comprehensive, can be consulting oriented. And of course, you can see our website here if you'd like to look at that for more details. So next slide. So here's our comic to get started as we normally do. You can see our bear and a bull. The bull is just a little bit nervous, obviously closed eyes until future notice. So we'll see how that goes. So with that, I want to turn this over to Alex to get started in talking about the current market conditions.
Well, thank you, Debbie. And thank you everyone for joining us today on this, I would say beautiful fall morning. I'm not sure about you, but I'm not a big fan of humidity. I play a lot of tennis. I try to spend a lot of time outside. So this is actually the best time of year as far as I'm concerned. So in terms of the market updates, again, this is the third time we're doing it this year. We will mostly focus on this particular quarter. We will talk about, the rest of the year. Perhaps I'll make some references to, what happened earlier this year. So in terms of this quarter, understanding, of course, we're not quite at the end of it yet, but already getting closer to it. In terms of the Dow, which is one of the major indices, as many of you know, we started the quarter at 25,700 points. As we speak today, it's essentially at 28,000. The market actually moved a little bit this morning. The Dow was down more than 1%, but interesting enough, I checked 10-15 minutes ago, it was back to essentially where we started. So that by itself represents an increase of 9% for just this quarter, which I would say is quite significant. In terms of year to date, the Dow is still in the negative at 2%. Perhaps it's almost like at a break-even point, but still in the negative. The S&P 500, which is a broader index, is up 5% for the year, and the NASDAQ is up almost 23%. I think it actually dropped a little bit this morning. It's more like 21%. And we're just talking earlier. Anytime I mention that, I'm so surprised that I've been saying that, given what's been happening with our economy, with unemployment, of course. Now, index such as NASDAQ is still up more than 20%. In terms of international markets, it's really a mixed bag, depending on what you're looking at. Developed markets are down somewhere between 5 to 6% for the year. Emerging markets as a group are actually flat, essentially, in a slight negative, with China leading the way at 12% for the year. In terms of the bond market, actually not much happened in this quarter, at least so far. The Barclays aggregate bond index, which is one of the most common benchmarks, is up 5% for the year. And then short-term bonds, we keep track of those as well, are up 2% for the year. So in terms of some of the economic updates, I usually start with that. The unemployment rates are currently at 8.4%, which is, of course, much better compared to where we were in April, but still not even close to where we were earlier this year at 3.5%. And actually, the Federal Reserve Bank, or the Fed, they released their latest expectations yesterday, and they're expecting the unemployment to drop to 7.6% by the end of this year. We happen to agree with that expectation. In terms of inflation, it actually picked up somewhat unexpectedly, currently at 1.4%. So perhaps closer to the year will go above 1.5%, but no one is necessarily expecting too much of it, at least now. So in terms of perhaps more of an important update, and this is again very recent, so I'll just read it to you and then we'll briefly discuss it. So the Fed officially changed its operating framework to allow inflation rising moderately above its 2% target. The Fed's tweak emphasizes its new thinking that the central bank can maintain accommodative monetary policy for longer, given its positive effect in pulling in workers into the labor force. So what does that mean in plain English? So if you asked me a month ago, I would tell you that perhaps our current extremely low interest rates would be with us for at least a couple of years, perhaps until the end of 2022. Now we're looking perhaps all the way to 2023, so 3+ years at this point. Now, for those of you who have significant allocations in bonds, specifically money market, CDs, anything of that nature, well, that would perhaps impact your thinking going forward. Now, in terms of the perhaps more positive updates, several companies, specifically 2 weeks ago at this point, decided to reinstate their dividends. A good example of that would be Dick's Sporting Goods. They actually decided to go back all the way to the figures to the dividends they had pre-coronavirus. Several other retail stocks also reinstated their dividends, but at a lower level, something like a third, maybe a half of the prior figures. In terms of our expectations, well, there's always going to be a company or maybe a group of companies that would slash their dividends for their business reasons, but we're not expecting that to be a market-wide situation this year. One thing that perhaps some of you noticed, or perhaps many of you actually did not notice that, but we had a correction. The NASDAQ, again, more of a technology index, it was down actually exactly 10% a week ago. And in terms of the definition, anytime a major index is down more than 10%, it's considered to be a correction. I don't want to say that we were necessarily happy about that, but perhaps it wasn't such a bad thing. Perhaps it calmed people down a little bit. And in terms of the sector performance, actually it's no different compared to where it was 2 months ago. Technology and consumer discretionary are leading the way, and then energy and financials are the weakest sectors for the year. And again, the difference between the best and the worst is quite astonishing to me. It's almost 70% for essentially nine months. But overall, the markets are recovering, and overall, if it stays as is, it's actually not going to be such a bad year. So the next chart or the next slide, and for those of you who attended our previous webinars, perhaps you'll be familiar with it. This is the model that we developed in April. Essentially 3 different scenarios, so-called bear, bull, and base cases. So where we are at this point, of course, we are getting closer to the end of the year. We do not believe that the bear case is a very likely scenario given what we know at this point, including again the Fed's meeting minutes that we reviewed yesterday. In terms of the GDP decline, by the way, the original figure was 6.5% in June. They recently, actually yesterday, updated it to negative 3.7. They're expecting the US GDP to begin recovering next year at 5%, and then gradually slow down to 3.5% in 2022. In terms of the base case scenario, we believe that's the most likely one as we speak today, meaning that we will have some kind of limited vaccine by the end of 2020. And I actually have some stats for you here. There are multiple questions asking for specifics. Unfortunately, we cannot go into specifics as part of this webinar, but I still have some stats for you. There are 40 vaccines that are being developed around the world. 9 of them are currently in phase 3, in the final stage of the trials. And both China and Russia, they already actually have 5 versions of different vaccines that they're essentially, testing. You may like it, you may not like it, you may agree or you may not agree with that approach, but that is where we are at this point. So base case is our thinking at this point. Now, this is perhaps the hottest or the most common question that we got over the past 2 months or so. Should I sell my stocks? And just to make sure we're on the same page, what I'm really referring to here is, significant liquidations, perhaps a third of your portfolio, half. We had a couple of clients who actually wanted to sell it all, expecting that we'll have, much more volatility later this year. So before you decide to go this route, well, consider the following. Anytime you decide to make a major move like that, well, chances are you're participating in market timing, meaning you're trying to predict the future, meaning that you have some kind of information that no one else has at this point. And perhaps many of you know, historically speaking, it's a low probability strategy. One of the reasons that's the case, in order for it to work, you actually need to make 2 decisions correctly. You need to know exactly when to sell, so that's one piece, and then you need to know exactly when to buy. Otherwise, it's not going to be all that beneficial to you, and there are definitely some costs of doing that. We'll talk about that in a moment. Here's one example. If you sold on March 1st and then you repurchased on April 1st, yeah, that would work quite nicely for you. If you decided to sell on March 15th, only 2 weeks later, and you repurchased on April 1st, also 2 weeks later, well, you would be sitting on a pretty significant loss. And if you sold again in March and you repurchase now, chances are you'd also be sitting on a pretty significant loss. For many people, it simply made sense to stay the course. The other piece, and I would usually bring that up, more of a psychological or emotional piece. If you're actually right, so let's say that you're expecting the markets will go down by 30+% in November or December, would you actually be comfortable with executing on your own thoughts? If the markets are really down that much, would you be able to repurchase? And of course, the opposite, if the markets continue to go up, 10, 20% maybe, would you repurchase then, or are you going to stay out of the markets for a while? I'll tell you, in our experience, I know several people, I know them personally, they sold in 2008, 2009, so they saved themselves a lot of money, but then they didn't reinvest for 3-4 years, and essentially they were worse off compared to those that just decided to hold. Now, if you need to sell for any reason, you need to sell, how much would you be selling? What is your target asset allocation? And here's a great example I have. We had a new client reached out to us 2 weeks ago. She's thinking about retiring soon. That's essentially what triggered that. And she wanted to talk about her investments. So we collected her statements, put together her asset allocation. We quickly discovered that more than 90% of her investments, it was a little more than $1 million, are in stocks and stock funds. So the question is, of course, should we be selling any? Well, how much? One way to approach this, and this is how we would usually do it, is to estimate or figure out how much is needed to support this person's specific cash needs for at least 7 years. And what is magical about 7 years, this happens to be this average business cycle in the United States. So if we're expecting the markets to go down by 30+%, on average, it will take 7 years to recover, and we want you to be protected. In this case, it was roughly $50,000. So you take 50,000 multiplied by 7, 350. You divide it by $1 million in this case. That gave us this target of 35%. I'll tell you, she was not quite comfortable with that. We bumped it up to 40%, and that was the target. We recommended that she gradually liquidates essentially 1/3 of her portfolio to prepare for potential market volatility. So how is this different? Again, it's a pretty significant change. Well, this is based on something. This is not based on this person's emotions, and as we'll talk in a moment, we're also not basing it on this person's political affiliations. So in terms of the perhaps more tangible pieces that we like to discuss, another good example, one of our clients, we've been working with him for a while now, reached out and basically said, Alex, just not comfortable with what's going on here. I really need to sell. And I understand it will cost me 15%. I'll be paying capital gains at 15%. So I actually knew this person very well. So my response was, well, you're actually in the highest tax bracket. So for you, it's actually going to be 20%, plus there's the state tax, plus the net investment income tax of 3.8%, which makes it closer to 30%, which is significantly higher than 15%. So that's the real cost of doing it. In some other cases, for some of our other clients, well, if you're invested in dividend-paying stocks and you decide to liquidate a big portion of them, well, you also have lost dividends or lost income. And if you're not reinvesting for the next 3-6+ months, well, it's gone. It's a permanent loss. Now, to finish this slide on something that is easier for us to analyze, if you're truly overweight in any particular sector, and I would make an educated guess and say in this year we're talking technology, consumer discretionary, and perhaps some healthcare stocks, well, that's usually at least a yellow flag from our perspective that perhaps, yes, this would be a good time for you to consider trimming and taking some gains off the table. So, Debbie.
Okay,
next.
So now we're moving into talking about the upcoming elections, and this is not meant to be a political commercial of any sort, but we're just giving you some insight to the 3 scenarios that we have here of what might happen in the market under these scenarios. And just to start out, I wanted to tell you some research from the U.S. Bank indicates that on average, when we have a new president come in, the market is usually up about 5% on average. If we have an existing president that stays in, or a new president that takes over the House and the Senate, it's averaging about 6.5%. And in the last 23 election years, 19 of them have been in the positive. So it doesn't mean there can't be a negative, but those are just averages to share with you. So the first scenario is we stay status quo. Trump wins. Right now, the Republicans hold the Senate, the Democrats hold the House. So at that point, we would think that there's going to be a potential market rally. The market likes stability. The market likes things the same, not speculating a lot. So we would think that would, be a market rally. And the sectors like defense, financials, technologies may stand to benefit, and some of the retail sectors may not. So that's status quo. Scenario 2 is that we have what we're calling this blue wave, where Biden wins and the Democrats take control of the Senate and retain the House. And I will tell you, the Senate right now, as you may know, there's 23 Republicans that are defending and 12 Democrats that are defending. And right now there's 53 Republicans, 45 Democrats, 2 independents. So it would only take 3 to 5 seats. It's for the Democrats to take control of the Senate. In the House, where the Democrats do have control, there's 435 seats, 53.4% are Democrats and 44.8% are Republicans. So in order for the House to turn Republican, they would need to take over 17 to 18 seats. So just from mathematics, it's less likely that the Republicans would be able to take the House just from that, again, the math to do so. So what would happen if Biden wins, Democrats take control of the Senate and retain the House? There might be a potential initial sell-off. That's a lot of change for the market to absorb initially in terms of what might happen. We would expect that there would be more regulatory scrutiny for financial, energy, and tech companies. We would expect that there'd be opportunities in the infrastructure, international stocks, as we might have less tariffs and a little bit more friendly situation for international trade. And then healthcare stocks would benefit, but not necessarily the pharmaceuticals. ESG, which you'll hear a little bit more about later, we think would investing there, where there would be some emphasis on the green stocks in that scenario. Scenario 3 is that Biden does win, but the Republicans do hold the Senate. So we basically have a split Congress in that scenario. This could be, in our opinion, one of the better scenarios for the market in terms of the friendliest, because it's a continuation of Trump's favorable tax rates that are there for corporation and deregulation. Right now, Biden, I didn't mention this earlier, obviously has a lot of potential tax increases that he's discussing. But in this case, there would be a split House, so there would be a lot of debate about that kind of thing. And deregulation efforts would continue. And so there would be a little bit more predictability also in terms of the international and the trade situation. Next slide. So again, we were just talking about how many seats are in play for the Senate. I just mentioned that, and also we didn't have a separate slide for the House, but I just went over that as well. That again, for the Senate, there's much fewer seats, maybe 3 to 5 seats for the Democrats to be able to take over the Senate. Okay, moving on.
All right, so
ESG.
This is one of the ESG slides that we wanted to include. And before I even get started here, what's happening in California is just really breaks our hearts. I mean, it's just awful. And I was looking at what's happening with the wildfires this morning. Some people are saying that perhaps they'll continue all the way to November. We have family and friends there, and I'm sure some of you as well. So it's just awful. And our thoughts are really with people in California at this point. So in terms of ESG, this is actually not something that we necessarily wanted to discuss in detail today, and what it stands for. It's environmental, social, and governance type of criteria. So the idea behind it is that besides, of course, looking for positive financial returns, investments in ESG, they must have positive social impacts. That's the basic idea behind it. Now, in terms of the quote unquote selling points, those types of investments are designed to be more resilient to economic shocks. And in terms of their long-term performance results, well, they're presumably going to outperform their peers because, again, they have more positive social impacts. Now, interesting enough, regardless of what you think of ESG, many of the strategies, including those that we track on our end, performed quite nicely in March and April of this year. Many of them are actually significantly outperformed their benchmarks, at least again this year. But that leads to one of the concerns we actually have, potential diversification risks. One of the main reasons, perhaps why they outperformed, is because many of them invest heavily in growth, specifically technology and related types of companies. And as perhaps many of you know, and as I mentioned earlier, those types of sectors have been the best performers year to date. And if you structure your portfolio, let's say entirely around the ESG criteria, which is possible at this point, say was not the case 5-7 years ago, well, at least be aware of that. It would most likely be a concentrated portfolio, even if you have 10, 15, maybe even 20 different funds. Now, for those of you who are interested in this approach, our portfolio manager Jenny Wong, an investment analyst Yunan Ding, they put together good articles. Actually, easy to understand. It's only 4 pages on ESG investing. We will be distributing the slides to you after this presentation, so we encourage you to check it out if you're interested. All right. So the next section here, this is going to be perhaps the most technical slide for our presentation today. And again, for those of you who attended our previous webinars, we try to include, at least one of our investment ideas. This is part of the same conversation, for those of you who need income, for those of you who prefer, again, need to maintain a significant portion of your portfolio in bonds. What are your choices? Given again that we will most likely remain this low interest rate environment for a while. So today we'll talk about so-called total return and multi-sector bond funds. So perhaps the best way to discuss these and describe what they do is to compare them to your traditional bond funds or traditional bond strategies, and that's what you see on the right of your screen. So the vast majority of traditional bond funds are really your classic buy and hold strategies. Some of them trade a little more, some of them trade a little less, but the core idea behind them, you have a team of analysts that are looking for the best possible bonds in this case, and they're trying to buy them at the lowest possible cost with the goal of holding them until maturity. The vast majority of these funds are either index or index based, and in terms of those that are more actively managed, usually they would be split between their quality and maturity. An example of that would be, let's say, a Vanguard high quality intermediate term bond fund. Now, one of the immediate advantages of traditional bond strategies, they're relatively easy to understand. The name in some sense implies what the fund is going to do. And if you look at the description, even on the website, well, you have a very good understanding of what they're trying to accomplish. Their performance results tend to be predictable. And what I mean by that, when you compare them to their underlying benchmarks, such as, again, the Barclays Aggregate Bond Index, in most cases, they would be pretty close to that. Now, in terms of our approach, and I would say many other advisors and clients of ours use them the same way, they're great to construct a buffer portion of your portfolio. So when I was referring to the 7-year ladder, from our perspective, a lot of that would be constructed out of traditional bond funds. In terms of their current disadvantages, well, low yields. That's the context for our discussion today. I'm excluding certain sectors, such as high yield bonds. Perhaps not that many people would want to keep a lot of those types of investments. And one of the things that I would say most tend to pay much less attention to, well, traditional bonds provide very limited interest rate protection. So again, it's all about stocks. But what about the bond market rally that we've been experiencing over the past 20 to 30 years? As many of you know, interest rates, they've been going down, down, and down. Well, unless we're expecting interest rates to be negative, perhaps from this point going forward, 2, 3, maybe 4 years down the road, they will begin to go up. Traditional bonds would not provide much protection in that type of environment. So that leads us to the 2 strategies that we'll discuss today. In terms of the definitions, I'll start with the total return bond funds. They're designed to maximize your total return, which includes your interest or coupon payments, capital gains, and even dividends. So in terms of capital gains, many of those funds would not hold their underlying holdings to maturity. with the goal of selling them at a better price so that you get that capital gain or capital appreciation. Some of the strategies, but not many, would actually include, I like to refer to them as fixed income stocks. Those stocks that have, very stable, very mature businesses that pay dividends, but again, they would specify that in their prospectus. Multi-sector bond funds, slightly different, usually entirely in bonds, and the goal is to invest in a wide range of sectors, treasuries, corporate bonds, of course, of different qualities, international bonds, emerging, including non-rated bonds. And by the way, non-rated bonds does not mean that they're bad. It just means that they're not followed by Moody's or S&P because they're smaller companies. Why would you ever consider these types of investments? Well, with the total return strategies, you look into balance your risks and returns. You want a portion of your fixed income portfolio to actually grow. And one of the advantages of the strategies, they're able to sell short inside of the fund. And as a result of that, there's this potential ability to actually take advantage of rising interest rates. With multi-sector bond funds, well, of course, there's this additional diversification inherent in the fund because it's in different sectors and perhaps better yields. In terms of our work, we currently keep track of 7 of these strategies. On average, you're looking at somewhere between 3 to 4% in yields that are by any means not risk-free. That compares to 2.2%, which is what you would get out of a typical bond fund. Now, one immediate disadvantage of these, perhaps you can gauge it from what I mentioned earlier, these are much more complex strategies. If you ever decide to go this route, I highly recommend that you do your due diligence. Here's one example of that. You look at let's say, a PIMCO total return bond fund, and you look at a Prudential total return bond fund. Well, their strategies are going to be very different. Their performance results will be very different. Out of those 7 that I just mentioned, the range in terms of their year-to-date performance is between 3 to 12%. 3 to 12%. So you see a lot of variation there. Market timing, and what I really mean by saying that, all of these are actively managed. You're not going to find an index fund that follows a total return or multi-sector strategy. So you really need to be comfortable with the management team. Of course, less predictable performance results, well, that is actually both good and bad, depending on how you want to look at it. And they tend to be more volatile in times of market turbulence. So to summarize it, and in some sense it is similar to what we discussed when we talked about your an allocation to preferred stock, these are not meant to be your core holdings. It is very unlikely that you should have 20, 30 or more % in any of these funds, but perhaps they can be used to enhance, again, your yields or your return, perhaps 5 to 10%. So for some of our, I refer to them as bond-heavy portfolios, usually 2/3, maybe even 3/4 is in traditional bond funds or actually actual bonds, and maybe 1/4, maybe a little more is in this type of funds. And of course, if you can do it in a tax-deferred account, such as your IRA, that would also come with an additional tax benefit. So consider that if you're looking for more income.
Very good. Alice, before we move into financial planning, do you want to see if there's anything in the chat box that we would want to address now related to the earlier comments?
Well, nothing necessarily in the chat box. One of the participants raised his hand. I'm not going to mention this person's name because, again, we're recording this. By the way, feel free to ask questions. I will read them out loud, but I will not mention your name. So this person, again, raised his hand. So please ask your question. In terms of some of the questions that perhaps we should cover right now, I guess this one is for you, Debbie. Any thoughts on the state of the real estate leasing market in the DC area and where it's headed?
Well, I think we know that people are working at home, and we know that office space is pretty much vacant right now, and people might be not renewing their leases. It's really not our area of expertise to predict, but it's really right in front of our eyes. So I think that the market there will be reacting to this situation, and we just have to wait and see what happens. Especially, I mean, we're talking about the commercial side, right? Commercial office space primarily.
Right. Okay, the other two questions I would say are also for you, Debbie, since you talked about the elections. How does the pandemic and the upcoming election impact the volatility of the market? Is this time to be less risk averse or more? And, you know, very similar question. What effect will the elections have on the market?
Well, I think I talked a little bit about the impact on the market that I mentioned with the research. And what might happen in terms of the different three scenarios I mentioned. So I feel like that pretty much covers that. In terms of the pandemic, I think that's just one aspect. I mean, you know, the parties are talking about Medicare, Social Security, taxes. There's a lot of things. The pandemic obviously is you know, right in front of us in terms of what's happening with the vaccine, what the attitudes are about that. And that's going to be really our sort of roller coaster going forward in terms of what's happening, besides just the election, I would say. That would be my opinion. And I think that, you know, when you look at this going forward, and we're talking about even somebody that's retiring at age 65 and they hope to live to 95, there's a 30-year period ahead of us. So while we're mindful of the short term and what can happen right now, somebody has enough reserves, they're not, you know, needing funds right now to pull out, then we would basically try to hold the course and stay more with their long-term plan. It's very difficult to time the market when anything volatile like this is going on. We've had debacles before, not a pandemic. Hopefully we'll never have another pandemic again, but we've had debacles in 2008 with the financial markets, the tech bubble, you know, other things going on with real estate. So I think we just have to be really mindful of staying put and, you know, paying attention to the long-term plan.
Entirely agreed. I guess the next one, this would be my way. I'm holding blue chip stocks that have eliminated their dividends due to the coronavirus crisis. Should I reevaluate holding them in my portfolio? And how should I reevaluate them? So the first question, easy to answer. The answer is absolutely yes. You should reevaluate it. Exactly why did they, eliminate or reduce their dividends, and what are your expectations, or let's say your advisor's expectations in terms of them, reinstating those dividends? Now, how you should do it? Well, that's I would say it's a more interesting question because it really depends on the underlying holding. I'm not able to make any specific examples, but I'll tell you this: anytime you're looking at a stock that pays more than 5%, chances are most of its long-term performance would come from its ability to make those dividends. In the vast majority of cases, those are not going to be your growth-oriented stocks. So if there's, if you believe that the dividend will not be reinstated anytime soon, well, perhaps there is lesser of a value for you to hold this particular stock. Now, if you purchased holding, and again, I actually have some good examples, but I'm not going to mention them, that provide a combination of the two. They pay, let's say, a small dividend, but they're also expected to grow. Well, perhaps that's not really a big deal for you. And if it's reinstated a couple of years down the road, well, that's great. If not, you still like the company. So my short answer would be, I would go back to the reason why you originally purchased this position.
Mm-hmm. Agree. Yep.
So a couple more questions here. This is a longer one, I guess. I would like to know the presenter's opinion whether we should expect the usual decline in stock price in December, and if it's a good idea to wait until then to buy stocks, as we will know the result of the election and have a better idea of the development of the vaccine. What do you think, Debbie?
I was going to ask you what you think.
Well, so this is, to me, this is a classic example of trying to time the market. You see, this would be a soft way of doing that. You see, this particular person, is obviously, more financially sophisticated, has a good understanding that, yes, in the vast majority of election years, prior to election and frequently post-election, there is more market volatility, but it doesn't necessarily mean that you have the ability to predict the exact timing of when you would be buying and selling. Now, just like in our normal year, let's say 2019 and prior, we always want to have reserves so that we can take advantage of potential market opportunities. That's how we refer to it. But again, should you be selling a third of your portfolio with the goal of buying lower in November and December? If you decide to go this route, realize you're participating in market timing and the odds are against you.
Yeah, and I just want to add on to that. I think there's a difference between doing things on sort of a dollar cost averaging basis or holding reserves and being able to tweak and put money in when you see an anomaly to some degree, but we're not trying to do market timing. So you're trying to keep the reserves that you need at all times. And then if the market sectors that you have asset allocation change, which in your scenario would, because the market would be going down, that would be a good time to rebalance. That would be the key, not to just try to time the market. Because as we know, we have a lot of things that have come up that aren't just necessarily fitting the norm.
Right. So the next question, I'm just going to read it. I would like to know their opinion, or our opinion, about the best moment to buy pharmaceutical stocks that are related to the treatment of coronavirus. Well, that's, again, we're not able to discuss this question. Regardless, even if we're speaking with you one-on-one, this would be a very speculative decision. As I mentioned earlier, there are 40 companies out there that are trying to develop a vaccine. Of course, there are going to be some winners, some losers, but one way or the other, this would be a very speculative call. Next question. In regard to bonds, what are the ones you recommend to hold for 10 to 15 years? So, I'm happy to at least comment on this one. No specific examples, of course, we cannot make any specific examples. Given where we are with interest rates and given what's available out there, it would be very hard for me to recommend any bond that you would want to hold for more than 3 to 5 years. So I'm just going to make this broad comment. And what I mean by that, by holding something for 5 years versus 10, maybe even 15 years, you gain an additional 0.2, 0.3%. But the risk of what may and perhaps will happen over the next 5 to 15 years is just huge. So buying something with the expectation of holding to 10 to 15 years, I'm not sure if it's a good strategy to begin with.
No, I would agree with. There is risk in bonds. We don't think about it the same way as we think about equities or stocks, but the risks in bonds, besides quality, that the company wouldn't go out of business or there wouldn't be a default, is one. But beyond that, it's the maturity date. So the longer the maturity date, the more risk you're taking. Very, very interest rate sensitive. So something like that would be hard to predict that you're going to get any kind of premium in the form of added interest, to Alex's point, that would be worth taking that kind of risk. And that, I'd say, was pretty much our opinion on that.
Right. Yeah. Next question. How often should one rebalance? Should frequency vary with market volatility? I think you actually touched on that, Debbie, a little bit. So would you like to address this question?
Yeah, certainly. When you're talking about a normal cycle where things aren't moving that much in any one direction, we're rebalancing annually. But take a look at what happened in March when the market dropped, or we've had other anomalies where the market dropped at the end of 2018, at the end of the last election, when anything was happening with the interest rate expectations. And when we see an anomaly like that, where there's a pretty large change in the market, then we would look to rebalance our portfolios then. And we're typically looking for a percentage, like something has moved not just 1%, but something's moved, say, 3, 5, 10%. Then we want to rebalance, and that's giving you the opportunity to go into the sectors that are lower priced and getting out and taking some gains on the sectors that have been in higher price. So it really depends. We also, back in March, were looking at taxable accounts that could harvest losses, that could take losses off the table and then immediately reinvest and really buy some tax dollars. That could be another reason to rebalance and buy something that's very similar, so you're not out of the market, but that you have banked some tax savings for the future. So I'm going to say it really depends. And we look at this regularly to decide whether or not to rebalance. But I would look at percentage changes. I would look at anomalies that have happened in the market.
Agree. Next question. Are we experiencing a recovery, quote unquote? And if so, what does that mean short term and long term? So
go ahead.
Cover that.
Alex.
Yeah, so
I think you can say something about that. Yeah.
Sure. I mean, in retrospect, it is easy to say. As we speak today, the markets, they pretty much fully recovered. There are definitely some sectors that are in the negative, but if you're looking at the S&P 500, even the Dow that is negative, 2% for the year, well, absolutely. Yes, there's it's more than 50% from the bottom, which happened on March 23rd. That's when the Dow was at 18,600 points. And it's interesting, by the way, when I didn't bring that up today, one of the descriptions for the recovery in April, one of the models was a so-called V-shaped recovery. So when I would bring that up, people would look at me and say, "Oh wow, Alex, that's a long shot." Well, essentially that's what happened from the market perspective. Now there is this disconnect. That's one of the reasons we included that funny picture as one of our initial slides between the actual state of the economy and how the stock market performs. And by the way, this is outside of our discussion today. This is not new. This is not a 2020 issue, and it applies to both developed and emerging markets. But I will leave it at that. This is not just a US type of issue. I don't know if you have anything to add to that.
I think that's good.
And then final question here. How do you guys see the real estate market in the next couple of years? Thank you.
Well, I mean, let's just talk about residential for a second. I mean, the market's really hot. Primary reason, at least in this area, low inventory, very low interest rates. So where that's going in the future, I really don't know. But we are in that sort of scenario right now where real estate is going at prime dollar. People are escalating prices. I'm hearing this all the time. And people are really trying to take advantage of these interest rates and lock in. So I don't know, but I mean, you're going to experience cycles in real estate just like you experience in the market. And as I mentioned about the commercial real estate, I mean, I think there's a lot to be seen there, right? Because of the staying at home, because people are not needing as much space, perhaps. I mean, that's all over the news. So where that's going and how people will adjust to that, I'm not positive. It's really not our area of expertise, but certainly it's all cyclical as well.
Okay, so one of the participants actually wants us to keep going. So we will address the rest of the questions after the presentation.
Okay, yeah, we just wanted to at least hit on some of the things now. We thought that might be helpful rather than wait till everything at the end, and then if people need to sign off, that happens sometimes too. So, okay, so this part of it is really talking about the top 7 financial planning considerations that we think are relevant now. So we're looking at things to just try to make some comments about how to think about all of this, just not even beyond just looking at the investment side. So, as we mentioned earlier, resisting the human nature to liquidate in a volatile market. I mean, we're all sort of traumatized by the news constantly. It is our recommendation to stay calm, as you can see, but it's also staying diversified, staying committed to your long-term plan, and not just trying to time the market and get in and get out and, be concerned about what you're looking at on paper, which is really unrealized. It's really what you're trying to realize down the road. And as an economist, Paul Samuelson said, who was a Nobel Prize winner, he said basically investing should be like watching paint dry or grass grow. And if you want to have some excitement, go to Las Vegas. So it really is a buy and hold approach and really paying attention to your assets long term. Reviewing your spending plan and keeping enough in reserves. Here what we're talking about is taking some time to look at what you're spending now in, let's say, this COVID environment, what you expect to spend when you're out of COVID. Mint has a great tool for doing that. We also have forms for you to look at in Excel if you'd like to, in terms of if you want to do some hypothetical. We're basically trying to feel more in control of the cash flow. So that's the whole idea, is I know where my money's going. I know what I'm saving, and I feel more in control of that situation. And then I know I've got, as I'm thinking through emergencies that might come up or contingencies, I know I have cash to handle that. We do see a lot of clients that really just don't have a clue, how where the money is coming. So we do recommend that this might be a time to take a look at that. Reviewing your long-term personal goals. Again, we've been saying a lot about that, but it's really downsizing, traveling. Am I going to make home improvements, which we're seeing a lot of that going on. And the biggie is obviously retirement. So most clients' assets as they're accumulating are in retirement, or they're designated for retirement, whether in retirement accounts or not. That's your biggest bucket for most people. So again, as I mentioned, even if you're 65 or 70, you're planning for 25 and 30 years, we really have to be focused on that long-term objective and not just, what's happening right now in the market. There's going to be many elections going forward. There's going to be many debacles going forward. And I just like to say that because what's happening now is happening now. That's true. But what can we predict about the future? So that's really the diversification process. Next slide. So this 4 and 5, I decided I'm going to discuss together. This is a little bit aspirational when we're talking about family discussions. There's a lot of dynamics that could be going on in the family, but in an ideal situation, we would be looking back a generation for you, and we'd be looking forward to your kids in that generational capacity, maybe even grandkids. So when we're talking about a family discussion, it also kind of involves estate plans. Like, do you know, in terms of your parents, what their plans are? Do you know where their documents are? Do you know how the cash is going to flow from their estate? Do you know if they've considered tax situation with that? Do you know if they, basically where all of their wishes are? In terms of that, whether it's in documents or it's not in documents. So it's really helpful to know that as we're planning for your retirement and what's going to happen down the road. A lot of times in retirement projections, we're asking, well, do you expect an inheritance? Do you think you're going to have any obligations for your parents? And it's just helpful to know. It's real information. And a lot of times we are finding that the parents have not really done the planning. They may not even have a will. They may not even have a medical directive. So those things are really important to know. And also, as I'm finding out, even with my mom, who's recently in assisted living, that I have to find her passwords. I mean, we just had an enormous amount of work just figuring out what password she used. There was no document that told us that. She did have something I had given her years ago, which is called the answer book. And it was a binder where you could list all your advisors, your insurance policy numbers, things about your car, all of that kind of thing. And I think the answer book is really a great idea. It's a good gift for your family, whether it's you doing it or your parents doing it or you helping them do it. And now you can get that kind of stuff online. You don't have to go to Staples and get the answer book binder. And then when you're talking about, family discussions going forward and we're looking at your children, here's again letting them know what your wishes are, where all of your information is, and have you done, as I mentioned, your medical directives, powers of attorney, and have you done your, looked at your trust documents and that sort of thing. This is a year that everyone's really paying attention to that for, I want to say, obvious reasons, COVID concerns, et cetera. But also looking at the flow of cash, as Alice has been mentioning all along, that we're going into a fixed income environment that's going to be very low interest, practically no interest, if you've got to hold a lot of fixed income. And if you're looking at your kids, and I'm talking about adult kids, and they've got student loans, car loans, they want to purchase their first house, they don't have enough cash to put down, so they go to settlement. They're still going to pay 2.6%, which is still a really good rate, but they're going to have closing costs. They may have mortgage insurance premiums, and you might be in a position to be the lender for part of that, to get the 2.6% to use, still secure your loan, still have a business document, make it very business-like. That's a win-win situation with keeping the flow of money in the family. But again, I understand personal dynamics and philosophies may come into play, but I think that's really important. And one thing I want to mention about trusts is, we had a tax law change in 2019 that inherited IRAs now have to come out over a 10-year period. they used to be able to come out over the recipient's lifetime, which is could be a much different amount of time. And trust documents, and even my own, I mean, IRAs are going into a trust to protect those as well, and the trustee would disperse according to the IRS rules. You do want to take a look at that and make sure the language is in accordance with what the new tax laws are. And you also may, even if you're just doing a beneficiary designation, might want to think about how that has accelerated in terms of, you know, somebody being able to get access to that money the way that you basically were thinking. So next slide. And this is a quickie. I mean, do an annual review of everything. I mean, somebody was asking a question about asset allocation and investments. That's true. But what about everything else? And pick your own cycle that makes sense. In fact, my husband and I are kind of doing that right now. We tend to do it right after Labor Day. Somehow after Labor Day feels like a more serious period of time. You know, we're going into our tax return is due 10/15. Yes, it's on extension. We need to make sure our withholding is correct. You know, we're concerned how we're going to come out by the end of the year. We're also, this is the time of year for us that our insurance policies, all of them are renewing. So you know, we're looking at long-term care insurance. We want to revisit that. We're looking at our umbrella insurance. We're looking at our home insurance, our car insurance, et cetera, and reviewing all that, all the contracts on the home, et cetera. So not just the investments. And of course, we talk about our estate planning wishes. So that for us goes on this time of year. For a lot of people, they're doing it during tax time because they're looking at their documents anyway, and they're getting their taxes ready. The only problem with that, I would say, is it sort of negates the year-end tax planning. Once the year is over, it's over. So there's not a whole lot that we can do. We also have a checklist for that, I should say. So I mentioned a lot of different things, but we have compiled a checklist of things that you might want to be looking at. And basically, you know, if you want any of these things, if you want the Excel budget form, spending plan, if you want the checklist, you know, we can send it to you. Just email us. That would be fine. We can do that PDF. And then the last thing I have is on charity, because we're coming into the end of the year, and very typically we're getting inundated with mail for charity. This is the time we might be focusing on that as well. Here, we just want you to be conscious of the strategies. There is a tax law change that is allowing people to take $250 above the line for those that aren't, you know, itemizing. A lot of people now are in the standard deductions, so charity deductions are not really, you know, giving them any tax benefit per se. But people that were doing their required minimum distributions out of their IRAs were able to direct it to a charity and basically get the deduction that way by not having to report that portion of the distribution. But this year we don't have to take required minimum distributions. This is a year that you basically said you're not required to. So what we were looking at is maybe you want to consider doing that in January when you're into the 2021 required minimum distribution. Maybe you can push off that, doing that until January. The other thing is if you are going to donate to a charity, consider doing appreciated stock. So if you have something in your portfolio, even appreciated mutual funds, you can direct that to the charity and be escaping that unrealized gain that's sitting there. So at some point in time, if it were to be sold and you have this capital gain, potentially up to 30%, as Alex mentioned, that would have gone to the charity. That would have been the perfect thing to give to the charity. And then I would say the last thing is the donor advised fund, which has been around a few years. And I would say that's for more significant donations where you want to do a lot now, which can benefit you to take you over that standard deduction, give you a big upfront deduction, and allow you to sprinkle those donations over any number of years and any number of charities, and even if you're giving $25, et cetera. So that could be a good tool for you as well. The last thing about that is if you're donating a lot of things in kind, like you're cleaning out a house and there's a lot of furniture and other types of things, if you're wanting to think that you're going to claim more than $5,000, you need to have an appraisal. So you need to find a charity that would give you an appraisal. And I'm doing that with my mom's house right now. So I'm focused on that because there's a lot of things that need to be donated. So a lot of times we run into people that haven't done that, and then they're limited because that's really an IRS rule. So that's all we have right now. We can address any additional questions for a few minutes. I know we're past 1 o'clock, but for those of you that want to stick around, do you want to see what other questions we have, Alex?
So we have actually 3 more questions. The first one is, I have $150,000 to invest. 13 years to retire. How should I invest? Would you like me to start, or would you like to?
Yeah, you can start. I'll chime in.
So from our perspective, again, we cannot make it specific, but you're essentially 2 business cycles outside of your retirement date. Again, if I work with my 7-year rule, my overall thinking is that a portfolio like that should be mostly equity or mostly stock based. Now, how quickly and to exactly what allocation you'd want to get, that's of course a discussion. Now, what other sources of income will you have once you retire 3 years down the road? Do you have any kind of pension? What about your Social Security? What are your actual cash needs? But my short answer is, again, 13 years down the road, again, given where we are with interest rates, most likely this should be an equity-based or stock-based portfolio.
Right, I would agree with that. And just one more comment. This is something you want to revisit every year. You know, we're really looking at this primarily mathematically and from a diversification standpoint. The art in this sometimes is that people walk in with whatever they have, right? Here's what I have. And they might have a lot of cash or something from an inheritance. And are we going to dump the apple cart and just move into what we think is ideal? No, we're going to basically smooth it out. And we don't necessarily want to move between sectors, and I'll say primarily fixed income and equities, just arbitrarily on a day that somebody walks in and say, let's do it. Because you might have experienced a March right off the bat. You know, it did recover, but, you know, we want to smooth out that transitioning to get to your model. You're always working towards that ideal allocation.
That's right. So the next question, I guess somewhat similar. If one decided that one's portfolio was unbalanced, too many bonds, would this be a good time to buy stocks? Or given that there is likely be some volatility around the election, should one wait for better opportunities then?
Go ahead, Alex.
Well, so again, this is
a similar question, yeah.
It's a form of market timing again here. I will just start with a story here, and this is more of a professional story. So in 2016, when Mr. Trump was elected, the markets were down more than 5% overnight. So I actually decided to, show up in the office much earlier than usual. I was there at like 6 a.m. So of course, there was a lot of phone calls in the morning, multiple phone calls. By the time the day was over, the markets were up more than 2%. And that essentially started the rally that ended in March of this year. So you really don't know. Like even our presentation today in terms of the outcome of the election, and of course that changes all the time, it is all speculative. It's much more reliable to have a target allocation in place. What is it that you're trying to accomplish? To have an actual plan in place. And then yes, given where we are now, and I'm not sure about your actual situation, usually we would want to do it gradually. I'm certainly not saying, yeah, you're in 50-50 today, your target allocation is 70-30, just to make an example. Let's get there next week. Usually it's a gradual approach, but event-specific investing usually does not work very well. That is a form of market timing.
Good. I agree. That's good.
So one of the requests, by the way, I'll just please make the checklists and the spreadsheets that you mentioned in a follow-up email. That way you're not with email. So we will basically email the checklist to everyone.
Yeah.
Okay, Deborah, have I misunderstood, or do you ask for extensions in your tax income returns until the fall? If so, why?
It's because I'm very busy at tax time. I also do tax work, and I've already done my projections in December. I know where I'm going to be in April. It just takes the stress off. There's no other reason. I mean, we're not trying to strategize about anything else. It literally, since it's available to us and we're just, not able to, my husband's a tax partner at CBM as well, then we're very busy then, so we just extend. And a lot of times we'll be done even in the summer, but we just can't really, put that much attention into it in April.
Okay. Next question. Why haven't been more stock splits lately? Should we anticipate more in the future? What does influence this particular trend? I guess I'll try to address this question. So the main reason for the stock to split, at least technically speaking, is so that many more people can actually buy the stock, right? So Apple was the latest one, Tesla. Perhaps more stocks will end up doing it. Maybe Amazon is next one in line. But that's the main reason. Now, from the market perspective, that usually shows the strength of the company, that they really believe that would not impact their ability to be listed on any of the major exchanges. So should we anticipate more in the future? Well, potentially, yeah. If you look at a stock that is trading at $3,000 a share, again, keep in mind, for many people, it's hard to just invest $3,000 and buy one share. That's the logic behind it. Keep in mind, some stocks like Berkshire Hathaway Class A shares, they never split. They're trading at what, $300,000 a share. I mean, I don't remember exactly, but it's some astonishing figure. So that's my answer to your question.
Okay.
Any other questions?
Okay.
In general, is a $1,000 plus, I guess, per share stock worthy, or is it better to buy more reasonable price stocks? I do not believe that is the case. If you like the stock at $30 a share, buy it. If you like the stock at $1,000 a share, buy it. If you don't like a stock at $1,000 a share, don't buy it. See, the issue is with those that are trading below $5. They're always at risk of getting delisted, and that is usually a major impact. I'll tell you, when we work with new clients, and anytime we see their so-called legacy holdings that are trading at below $5 a share, almost always we yellow flag them, at least with the goal of gradually eliminating. But in terms of, again, the price per share, it's not even a factor from our perspective.
Mm-hmm. Great.
Great webinar. So much useful information. Well, thank you. And thank you for, someone said thank you. So thank you for saying thank you. All right.
That's it. So the next slide, thank you guys for attending. There is a slide here that's about our upcoming events. As you know, this was recorded, so there will be information on the website too if you want to see this again, and also our upcoming events. And I think with that, we're done. So I hope everyone has a nice rest of the day. Stay well, and we'll be back with you in November after the election is over. Thank you.
Thank you, everyone. Have a great day.